It's my honor today to introduce today's Bradford seminar speaker, Linda-Eling. The seminar is co-sponsored and co-hosted today by the Julius Rabinowitz Center for Public Policy and Finance. Linda is the founding director and head of the Morgan Stanley Capital Investment Sustainability Institute. She joined MSCI, as it's called, in 2010, following its acquisition of Risk Metrics Group, where she led environmental social governance ratings research and headed consumer sector analysis. Linda serves as the director of the U.S. Sustainable Investment Forum and as a fellow of the Finance Leaders Fellowship of the Aspen Global Leadership Network. She currently serves on the advisory council of the IFRS Foundation, a not-for-profit responsible for developing global accounting and sustainability disclosure standards, is a lead author of the Intergovernmental Panel on Climate Change's 7th Assessment Report. She was named one of the top 100 women in finance by Barron's in 2019 and 2021, and was voted #1 for an individual making the most positive overall contribution to sustainable investment corporate governance in 2018 and 2019. She's on the board of directors of USSIF, the Forum for Sustainable and Responsible Investment. Linda's published research in both management and investment practitioner journals, as well as in top academic peer-reviewed journals. She's a frequent media commentator on climate and sustainability investing in outlets including the Financial Times, the Wall Street Journal, and CNBC. She holds a BA in East Asian Studies from Harvard, a master's from Oxford in Modern History, and a PhD in Organizational Behavior, again from Harvard. Today she'll tell us about following the money, private sector climate investment, and the data behind it. Please join me in welcoming.
Thanks, everyone. It's really great to be here, and it's really such an honor. I'm grateful for the invitation. My name is Linda-Eling Lee. I am the founding director of the MSCI Institute, and I know that MSCI is probably not a household name for many of you here, but I hope that by the end of this talk, you'll have a good sense of why what it is that we do matters for the questions that I think you care about in terms of climate. What I'd like to do today is to take you inside a system that most people outside of finance don't get to see very clearly. That's the system through which the world's largest pools of capital are actually how it is that they're responding to climate change. And I want to open the hood on the data infrastructure that powers these investment decisions, because I think that many of you in this room work on questions where understanding what institutional investors can and cannot see in their investments can be very relevant. So the title of the talk is Follow the Money, and I've organized this into 2 parts. The first part will be an overview on the investor landscape. You know, who are the investors that are moving capital on climate? Different types of investors actually have different constraints and motivations. I'll walk you through the evolution of climate investing over the past decade, some of the successes and the failures, and what the current state of play looks like. And then the second part of my talk is about the data. So the nature of the data that private sector finance uses is one of the most important, I think, and least understood parts of the story. I'll walk you through the types of climate-related data that are relevant to investment decisions, what the recent innovations are, and how they're actually being used in practice. So let me start with just a quick snapshot of where I sit in this ecosystem. So MSCI sits at the center of the world's financial plumbing. We are a publicly traded financial services company that's headquartered in New York, but our team and our clients are extremely global. So our clients include asset owners, investment managers, banks, and insurers. And the most important segment among those for understanding sustainable and climate investing is what we call asset owners. These are the pension funds and the sovereign wealth funds that collectively represent tens and trillions of dollars that are the savings of teachers, nurses, public employees, and retirees around the world. And what we do for our clients is to provide them with the data, the analytical models, the indexes, all the critical tools they really need to make better investment decisions. Over $18 trillion in assets are benchmarked to MSCI indexes, and we are the largest provider of any type of sustainability and climate data and analytics to global investors. So I mention all of this not as a sales pitch, but because it gives you insights into why it is that we've had so much visibility into the world's largest investors and what it is that they're actually doing and asking when it comes to climate. So I lead our institute, which is our research arm that collaborates with academic researchers and policy researchers and with standard setters to share our data and to try to bridge this gap between what it is that practitioners need today and tomorrow and what the evidence base can actually support. All right, so I'm going to start with some context for how it is that we got here. And I also want to just clear up some of the misconceptions about the terms that we use in our domain. So if we go back 20 years, the term responsible investing or socially responsible investing really meant something relatively simple. It was mainly about excluding certain types of investments and certain types of companies from your investments. It could be tobacco, it could be weapons, it could be gambling. So investors with religious and ethical convictions have always done this for 1,000 years. Then around 2006, the United Nations launched the Principles for Responsible Investment, and this idea of ESG, environmental, social, and governance factors started to take hold. Now, ESG is a funny acronym. It's become very politicized here in the US, but for institutional investors, it is actually kind of a boring, wonky shorthand for the factors that you can't find in companies' financial statements. These are the factors that give investors a more holistic view of how a company is actually run and how much foresight the management team might have to emerging risks and opportunities. So over the next decade, investors really started to demand more and more of this kind of data. This is not data about whether a company was good in some sort of moral sense, but it's really data about things like poor labor practices that might hold back worker productivity at a company. It could be pollution incidents that can trigger lawsuits or plant shutdowns. It's about weak governance that allows accounting tricks and fraud. So it was really a revolution in terms of transparency and for better measurement of risk. And that really matters because transparency and more accurately measuring risks are really critical to capital markets. They allow investors to allocate capital more efficiently. Companies that carry greater risks should cost more to invest in because investors demand to be compensated for that extra risk. And now you can better see some of these risks. So today, when we say sustainable investing, it really encompasses a whole spectrum of approaches. We still have this traditional ethics-based approach, making values-driven exclusions that include whatever it is a particular individual investor might care about, whether that's human rights or fossil fuels. We have impact investors, which are the positive corollary to values-based approach. These are investors that want to intentionally allocate to more specific positive outcomes that could be about water sanitation or promoting education in specific communities. And then we have growing regulations as well around the world that some investors actually have to comply with when it comes to sustainability factors. But what has really powered this movement is not values. It's actually, and it's not impact and it's not compliance, even though these tend to really dominate the headlines. So at the heart of this movement has been really a financial motivation. The need for better information to better manage and measure risks and improve long-term investment outcomes. This is very much a financial motivation and it's core to how investment decisions work. Now, notice, I think it's very important that what I'm talking about is long-term investment outcomes. Okay, the investors that care about long-term outcomes, you're not going to find them on betting markets or on day trading platforms. So the investors that matter the most for this movement have been the largest asset owners that I noted at the beginning. These are pension funds and sovereign wealth funds and the insurance companies, institutions that have a financial obligation to be paying retirees or other liabilities that they have many decades down the road. And because these investors are very large, many of them, their investments are fully exposed to all parts of the economy. So as an example, the Norwegian Sovereign Wealth Fund, it's so large that it owns on average 1.5% of every single listed company in the world. So we call these kinds of investors universal owners for that reason. The universal owners are not, they are constrained by their size in how much they can actually diversify in their portfolios to protect their assets, and that's why they care about large systemic risks such as climate change. So now let's talk more specifically about climate And climate investing, it's really had its own story, and it's happened much more in a compressed time frame. I will talk about it in terms of 4 chapters that have occurred over the past decade. So chapter 1 started around 2014 with something called the Montreal Carbon Pledge. So this is a group of large investors that committed to measuring and reporting on carbon emissions of their investment portfolios. Now, even at the time, it wasn't entirely clear whether the goal was to understand financial risks from carbon exposure or to understand investors' contribution to global emissions. So different motivations actually require quite different methodological treatment, whether you're measuring emissions intensity or whether it's your ownership share of the absolute emissions from the companies in your portfolio. That tension between measuring risks for the companies in your portfolio versus the impact that they might have on the world has never been fully resolved in this space, and it runs through everything that has followed. But what this chapter did accomplish, I think, is quite remarkable, and I think it should be noted. It really kicked off a decade in which listed companies started to measure and report on their emissions at the demand of investors. So today you can see this trajectory from 2015, and today more than 76% of the global universe of listed companies now report on their Scope 1 and their Scope 2 emissions. These are roughly now about 8,500 companies that account for over 99% of the world's equity market capitalization. So that is a massive shift in corporate transparency, driven primarily by investor demand, not regulations, which are still catching up when it comes to emissions disclosures. Now, chapter 2 really started when Mark Carney, now better known as the Prime Minister of Canada, was then the governor of the Bank of England and the head of the Financial Stability Board, and he gave this famous speech, The Tragedy of the Horizons, in 2015. He laid out the long-term systemic risks of climate change to the financial stability. But it wasn't until actually the lead up to the Glasgow COP in 2021 that a critical mass of financial institutions then made this public commitment to align their portfolio's emissions with a decarbonization path towards net zero by 2050. Now, similar to the Montreal Carbon Pledge that we just talked about, when portfolio carbon footprinting wasn't yet a standardized approach, investors at the time of this Glasgow Financial Alliance for Net Zero had not yet established how to actually measure portfolio alignment to net zero. Yet, even though that wasn't really clear at the time, the commitment did have a cascading effect. Because in order for investors to meet their pledges, however they end up measuring it, they knew that the companies in their portfolios actually needed to get on a decarbonization path of some sort. And that's why you can see here in the data at that time, this huge ramp up of companies making climate commitments in that period. So the top line that you're seeing there shows companies making any type of decarbonization commitment. And then the second shows those that labeled their commitment net zero. And then the bottom, so this is self-declared. And then the bottom line tracks the targets that have been verified by the Science Based Targets Initiative, which had been established to meet the needs of companies that wanted to have a third party verify the rigor of their commitment. But here is kind of where reality kind of hits, because despite all of these commitments, decarbonization at the rate necessary to stay on a 1.5 degree path has been exceptionally difficult. Today, only about 12% of the world's listed companies are on an emissions trajectory going forward that would be consistent with a 1.5 degree path. And this gap between commitment and performance is large. So I will say a little bit more about this, this temperature alignment in the data section. Now, if companies are not decarbonizing fast enough, then the only way for investors that have made their portfolios commitments to be less carbon intensive, the only way they can try to even meet those objectives is to exclude or to divest from high emitting companies that are in their portfolios. Apart from the fact that there are financial costs, more fundamentally, doing that doesn't actually reduce emissions in the real economy. So the companies you exclude as an investor do continue to emit in the real world. They just leave your portfolio for accounting purposes. And this is a very important lesson which many investors have had to grapple with and struggle to communicate to policymakers and to stakeholders. The proposition, I think, that finance can lead the transition to net zero, it's been recognized as somewhat flawed because finance can be slightly ahead of the real economy, but it cannot be completely divorced from it. You have banks that cannot actually lend to a hypothetical economy that only has net zero companies in it. So it's a structural constraint in this movement, and it wasn't really a failure of ambition. This is also why I think you've seen a lot of headlines and a lot of focus on banks and investment institutions pulling out of net zero alliances. Now, of course, some of that is very much due to political pressure, especially here in the US, but it is also a recognition that the original framing was overpromising what it is that financial institutions could actually deliver on their own, right, when the real economy simply wasn't keeping up with decarbonization. So that brings me to a third chapter, which is we call transition finance. So in practice, transition finance means deliberately, actually, intentionally investing in companies that are hard to decarbonize, sectors like steel, cement, shipping, transport, and using those investments to motivate emissions reduction. So in the short term, what that actually really usually means is that your portfolio looks more emissions intensive, not less. And so for investors who care about reducing real economy emissions, though, and not just making their portfolios look cleaner on paper, this has become a very powerful theme that continues. Now, the Inflation Reduction Act gave really a very significant tailwind to this movement of transition finance. It created a great deal of momentum and investment opportunities that attracted not only these investors that are already focused on climate-themed investments, but also many investors around the world who simply just saw the energy transition as a financial opportunity. Now, with the rollback in US policy, while other markets actually power ahead, the transition finance movement has now become more fragmented. It is more complex. A lot of the investors that we work with continue to find opportunities to invest in transition, but this landscape requires much greater nuance. It requires a lot of agility and ability to analyze how policy headwinds and tailwinds could actually impact any given technology trajectory and adoption in different markets and sectors. And even as transition investments continue, investors have started to worry about the reality of climate impacts. And this brings us to chapter 4, which is where we are now, where the bulk of investor attention today is on physical risk and resilience. So around the time of the 2024 US election, our institute had released a survey showing that almost 60% of global investors believe that physical climate risk will have significant economic impacts. At the time, though, only 7% believed that asset prices actually reflected those risks. And here, from the same study, I'm just showing you a comparison of what the Guardian news source had found by surveying IPCC scientists on the most likely temperature rise by 2100 versus what we found when we asked the same question among investors who are not climate specialists. So it's a kind of an interesting comparison in distribution given the wide gap in knowledge between the two groups. But most of them agree that we're at least headed towards about a 2.8 degree temperature rise by the end of the century. Now, the upshot for this, for investors, is that investors now think that transition risk from policy changes is simply not immediately on the horizon. It's going to play out over a longer time frame. What is actually now immediate is the escalating cost of extreme weather events, as well as the realization that chronic hazards like extreme heat and their impact on human health and productivity have really not been something that's been factored into how investors price assets. But that's now changing, and measuring the vulnerability to physical climate hazards is really at the frontiers of where the capital markets are really focused on at the moment in climate. All right, so let me ground a bit of that narrative, I think, in some of the numbers. I'm drawing from a report that the MSCI Institute publishes regularly to track the progress of the world's companies and funds. It's called the Transition Finance Tracker. You can always find it at MSCI-institute.com website. All of these charts and slides and so forth, you'll always find them. They're publicly available. So you're welcome to take pictures, but you can also just go to the website. All right, so in terms of fund flows, global sustainable funds, all type of sustainability funds, the assets have reached probably about $4 trillion or so at some point last year. And within that, what we see for climate funds, so these are public listed funds that have any kind of a climate theme to it, is about $500 to $600 billion. You can see this ramp up over the last 6 to 8 years. And then the climate funds that are the ones on the right are the ones that hold unlisted assets. So these are infrastructure funds, private equity, private credit, venture capital. I think they get more headlines, but they really are considerably smaller than the listed funds. Now, one thing I wanted to point out when it comes to looking at fund flows is that geographically, Europe really dominates as the source of climate capital. So on the left-hand side where you see these two bar charts, what you're seeing is a comparison between where the investors of climate funds are actually domiciled. So you can see that they're primarily 60% of them are based out of Europe, compared to the bar below, which is where the companies in those funds are actually domiciled, which, as you can see, is 60% are based in the US. And you can see that the majority of those companies, the disjunction between the source of the capital as well as the destination of the capital, that is something that is actually a real feature of climate capital, but you can also see on the right-hand side something that we noticed last year, which is that when you've seen this kind of same distribution over time, with U.S. companies accounting for the vast majority and actually up to about 70% of these funds' assets. But last year we saw this 10 percentage point drop in U.S. shares as a destination for climate investments. So these climate funds are actually, it's very interesting to track what they look like, and they are more visible to the public. But in our view, it's actually less consequential compared to something that's much harder to see. A very large share of climate-aligned assets in the world are not in the kinds of funds that you can actually invest in a brokerage account. All right, so it's in these massive institutional mandates. These are the pension funds and sovereign wealth funds again that have adapted and adopted climate benchmarks for their entire equity portfolio. So just to give you some context for numbers, there are right now about over $1 trillion that are tracking MSCI's range of sustainability and climate indexes, and only 40% of those are actually tracked by ETFs that can be bought and sold in exchange and the sorts of things that you see on this chart. The other 60% are actually assets in these institutional allocations. So who are these major allocators? Well, you probably can't read this, and you're not meant to read it. What I'm trying to show here is actually the breakdown. So the top row is actually the Americas, and then it's Asia, and then it's Europe. And as you can see, European asset owners really make up the bulk of these benchmarks. In fact, virtually all major European asset owners today have some type of climate overlay on their equity benchmarks, and equity tends to be about 40 to 50% of their entire portfolio. You also have in Asia leading asset owners like New Zealand Superannuation Fund that had already some years ago shifted 40% of their entire portfolio to indexes that meet their own climate objectives. It's very important when you kind of look at all of these different asset owners, they actually pursue different approaches that align with their different specific investment and climate objectives. Some of them are going to prioritize reducing emissions intensity over time. Others are going to be prioritizing the improvements that they see in the portfolio company's carbon risk management. So I think it's really important to show this often, because I think that benchmark changes are not something that's going to be headline grabbing in the way that when you're launching a new impact fund or a new climate tech fund might actually be very headline grabbing. But these are actually much more systematic shifts in how the largest pools of capital in the world are allocated, and I think that's really very significant and very little noticed. All right, I want to shift now to data and the measurement challenge, because to make the kinds of investment decisions I've been describing, investors really do need quite a lot of data. And the data challenge in climate is fundamentally different, I think, from traditional financial analysis. So investors tend to allocate capital by country, by sector, by asset class, the main asset classes being public equities, bonds, and private assets such as real estate, infrastructure, private equity, and other alternative assets. That's really how investment portfolios are organized and are constructed. But climate risk, of course, doesn't line up in any one of those categories. The sources of climate risk, whether it's from policy, from technology, or from physical risk, just don't line up neatly with country, sector, and asset class. So where can you find this kind of data? So if we step back from climate first, this is kind of the total landscape of data that investors today demand. And they include all types of information on the companies that they invest in. It can be on safety violations. It could be on water consumption. It could be on governance practices. And I think the key message here is that you can imagine that company reporting actually only covers a very, very small fraction of what it is that investors need. So to support investors' needs to cover their total portfolio of investments across all these different asset classes, what we have to do as a data provider at MSCI is to analyze and make comparable far more information that we gather about companies than information that come from companies themselves. So if you're only using company reported or disclosed data, you really are only using a very small sliver of the information universe that investors are using. And increasingly, the most important data comes from non-traditional sources. They can come from satellite imagery. They come from geospatial data, news, litigation, government data, NGO reports. It's really a vast universe of data sources out there. So let's come back to climate. And let me walk you through the high-level logic of how we categorize the various types of climate metrics that investors use. So we provide probably 1,000 climate-related metrics that cover the underlying holdings in a portfolio. So conceptually, how do you divide up these 1,000+ metrics? So conceptually, we're really distinguishing between those metrics that tell the investors something about the impact of the companies on the world versus the risks that those companies embody for investors. And then within those, we're always distinguishing within each of these categories, what is a snapshot of today versus projections that are more forward-looking about that same exposure. Now, why do we produce so many of these different metrics in the first place? Well, they're really always produced to answer questions that investors have about their portfolios. So to try to explain the data and give you a flavor of the types and the varied types of data that and models that we have to produce, let me organize the climate metrics around some of the key questions that investors try to answer. The first is how much carbon is associated with my portfolio. That is the most basic one. Are these companies on track to decarbonize? And then we get a bit more complex into what is the financial risk to my portfolio from climate change. And then the newer areas are around where can I find opportunities to invest in the energy transition and what are our exposure to rising physical risks. So I'll take you through examples of the kinds of data that are used to answer these questions. All right, so first up is how much carbon is associated with my portfolio. So emissions data is the one that I think everybody's the most familiar with. It is the most basic metric that underpins much of the analytical layer that we put on to produce usable climate metrics. And so for every single company, investor needs its Scope 1 and Scope 2 emissions, which are the direct emissions and those from purchased energy. But Scope 3, of course, is the emissions from a company's entire value chain, its suppliers, its customers' use of its products. That's where the majority of the climate impacts are. Now, I had shown you earlier that more than 3/4 of listed companies now report on Scope 1 and 2 emissions, but smaller companies, especially a lot of US companies, do not yet report. And so disclosed data on Scope 3 falls much further behind, but it's also completely not usable to investors. We do actually provide that data, but investors don't use it because there's no way there's no standardization with the disclosed data. But in general, investors have to rely on estimated data. I think the estimates for emissions have become much better over time. But that's just very basic. The more complicated part of answering this question is actually how to normalize the data to meet different investor needs, even as they're asking the same question about how much carbon is associated with their portfolio. What do you put in the denominator, and how do you actually aggregate across holdings? That's really the main value add that we're providing. So here is a snapshot here. I just put up, it's a schematic that I extracted from one of our methodology documents. And what it does is just walks a user through a decision tree so they can match their specific objectives with the appropriate measurement. So if what you're trying to do is to compare carbon footprints between two portfolios that you have as an investor, you should be using financed emissions intensity, which is the emissions per $1 million that you've invested. Now, if you're trying to evaluate more kind of sector-specific carbon efficiency, you're trying to choose which companies are more or less efficient in an industry, you should be using production-based intensities, such as using emissions per ton of steel, rather than using a revenue denominator. Now, the revenue denominator, of course, gives you comparability across sectors, but it wouldn't help you necessarily as much in trying to differentiate between companies in specific sectors. So this is how we end up having this huge number of metrics, because they actually do all have different uses and answer different questions. So the next question is, are these companies on track to decarbonize? So measuring current emissions is necessary, it's not sufficient. What investors really want to know is where the companies are actually headed, what kind of a path are they on. And there have been really a number of industry efforts to try to develop standardized measurement frameworks for alignment. I give you two examples here. These are probably the most dominant. One is an implied temperature rise metric. And what that does is it translates a company's current emissions trajectory into a temperature outcome equivalent. So what you first do is we allocate each company its share of the remaining carbon budget, and then based on its specific sector and its market, right? And then we compare that budget to their projected emissions, based on their recent performance as well as their commitments. And what we're doing is comparing the two and then calculating how much of that projected emissions will exceed its carbon budget. And the model essentially estimates that if every single company in the world overshoot its allocated carbon budget or undershoot its allocated budget, the same as this company does, what temperature would we be heading towards? It's just a very kind of simple way of trying to compare companies and their relative to their own carbon budget. A different approach on the right, which many investors actually use, is they want to sort their portfolio into categories that adhere to one of the industry frameworks. It's called the Net Zero Investment Framework 2.0. So it's a different version. So what we've done is built this tool to evaluate every company on the dimensions that are in this framework, such as whether the capital expenditure are actually consistent with a net zero path, what are their long-term ambitions, and so forth. There are a number of criteria, and then what happens is then you can sort these companies into the categories that investors want, which is what proportion of their companies are not aligning with net zero, which, as you can see, is all of those really dark blue ones, and then which ones are actually have achieved net zero, which you can barely see. That's supposed to be the dark green one. All right, so that's about temperature. About companies' progress. So next we get a little bit more interesting, I think. We're entering the world of scenario analysis, and we're asking, trying to answer the question of what is the financial risk to my portfolio from climate change. So this is difficult because climate scenarios developed by scientists are not easily translatable into the kinds of data and analytical tools that investors can readily use. But investors do actually need to understand how different possible climate pathways and futures will translate into financial impacts on the companies that they own. So a group of central banks called the Network for Greening the Financial System, NGFS, has developed a number of these standardized climate scenarios that financial institutions can use to better understand the potential impact on their portfolios. And this is what you're seeing on the chart on the left. This is an NGFS diagram where you're seeing the scenarios positioned along physical risks and transition risks. Now, these scenarios are are highly imperfect, of course, but financial institutions really do need some standardized approaches in order to analyze potential impacts, so they do find the NGFS scenarios very useful. Our role is that what we do is we calculate what we call a climate value at risk measure, which estimates the present value of the climate-related costs as a share of the company's enterprise value across a range of scenarios that have been set out by the NGFS and other kind of IPCC scenarios for physical impacts. Now, this is also, of course, imperfect, despite its complexity and the evolutions in terms of improving it, because these types of exercises that estimate potential financial impacts of adverse events, they've typically relied on lots of historical data about how asset prices have actually behaved in response to an actual market shock in the past, such as the financial crisis or a sovereign debt crisis. There's actually no historical data to reflect how future climate effects, which in themselves are also uncertain and evolving as they unfold, how that could impact asset prices across countries and sectors and asset classes. So it is highly imperfect, yet doing this exercise has helped banks and investment institutions really better understand just some of the basic relationships we're talking about. So for example, that climate transition risks and physical risks move in opposite directions across the scenario range, right? So in a world where you're decarbonizing very aggressively, your transition risks from policy and from technology disruptions are going to be very high. And so companies that are in fossil fuels, heavy industries, carbon-intensive sectors, they face very significant valuation impacts in the nearer term. In a world that fails to decarbonize, if you're headed towards a 3-degree or more pathway, then physical risks from extreme weather events are going to dominate that financial impact. And those physical risks, could be significantly more severe, of course, across sectors. And in a 4-degree world, for example, we know that it's multiples of what it would be in versus a 1.5-degree world, but it accumulates over a much longer time horizon. So every company and every portfolio is sitting in this tension, right? And every policy choice is shifting the balance between these two types of risks. For investors today, they're just at varying stages of trying to incorporate this type of thinking and this type of analysis just so that they can better understand what could happen. So the chart on the right is an example, is an extract from a report that's made by one of the world's largest investors. And the fact that they do this exercise across the different scenarios is really an education journey for themselves as well as their stakeholders about what possible futures might hold for their investments across these highly stylized climate scenarios. All right, so next question is, where do I find opportunities to invest in the energy transition? So investors have fiduciary obligations, of course. They have to pay pensions of future retirees, which means they are constantly on the lookout for opportunities that can generate the highest returns for the least risks. And how do investors find these opportunities in the energy transition today? Well, today, of course, in particular, there are some really broad transition drivers unfolding at very different paces around the world. And depending on the business and the specific market and the policy jurisdiction, they actually create very different types of financial impacts for a portfolio that has companies across sectors and across markets. We know that electrification, for example, and load growth, that's going to be creating product opportunities for companies in making solar panels, batteries, and so forth. At the same time, you have regulations and shifting consumer demand that is creating product risks for producers in certain types of industries. Think about autos, right? And then for heavy industries, the airlines and the cement factories and the chemicals and so forth, the operational costs of technology adoption really depends a lot on the policy support as well as the company's own progress. So investors are really looking for a way to measure that can help them systematically scan the horizon for these differences so they can lean into the company that are more well-positioned to capture growth in the next 5 years. So I just show you one example of the sort of thing that we have to work on to try to meet these types of demands. It's an energy transition framework that my colleagues at MSCI recently developed that tries to systematize some of these dynamics. So essentially, the research on technologies and markets and companies are translating into metrics that can compare how much transition pressure a company actually faces with how ready that company actually is to manage that pressure. And so as an example, to capture transition pressures, our analysis would be looking at a number of factors to include, such as the commercial readiness of over, I think, 90 technologies that the analysts have looked at, the geographic exposure of the company's operations to the various policy commitments that are being made in the countries where it operates. So this schematic is really just to give you a sense of how data providers to investors like ourselves need to continue to find ways to systematically grab different types of information, combine them, the quantitative and the qualitative data that come at different levels of analysis in order to create some standardized frameworks to help investors in their investment decision making. It's very much an R&D process that involves consulting many of our clients to understand the usefulness. All right, so now we get to the part where it is actually the bulk of the attention of the investment world at the moment, which is on physical risk. What are our exposure to rising physical risks? The investors don't invest in locations that you can identify on a Google map, right? They invest in securities of companies, but those companies own and operate physical assets. They are factories and warehouses and mines and data centers and retail operations that are located in specific places, and those specific places are, of course, exposed to a specific set of hazards that are going to change over time. And that's why, to serve this need of investors to better understand their physical exposures, we've been focused on developing a geospatial assets intelligence database that really links over 3 million physical assets to 700,000 companies so far, and that keeps growing. We gather data and we estimate not only the physical characteristics of each physical asset, but their economic value to the company that owns that asset. So for each of those assets, of course, we can overlay granular physical risk data, and this is we do this in partnership with Swiss Re and using some of their catastrophe inputs to their catastrophe models. So we cover 28 hazard types, and that physical risk measure is translated into a financial impact that's estimated from potential asset damage and from business interruption, and that's associated with the hazards affecting each location, and then it's aggregated to each company. Right? So the hard part of all of this isn't the hazard modeling, because in finance we're just using what's being produced by science and the scientists that some of you guys produced for climate models. For the financial use case, the hard part is really this linkage, trying to connect each physical asset with an estimate of its economic value to a company, and then the company to the security that the investor actually holds. And increasingly, these linkages don't just happen with companies in the locations they own. It's actually also to their supply chains, because an investor needs to understand not just whether a company's own factories are in a flood zone, but whether or not its critical suppliers are. Okay, so how do investors actually use all of this data? It seems very complex, but let me just run you through a case study that we did recently to kind of bring it a bit more to life. So we had 18 asset owners representing about $4 trillion US in total assets, and they gave us their equity portfolio holdings. And across these 18 asset owners, they held about 11,000 unique companies in them, and were able to map 500,000 physical assets that are underpinning those companies and those holdings. So even though when you think about kind of asset owner portfolios, they often have a regional investment bias, meaning if you're a European asset owners, you might hold more companies that are based in Europe. These companies are very large and they're very global, and therefore the exposure to extreme events can arise from somewhere that's very far away from your home market. So this is just an example of one of those kinds of portfolios where you had a European asset owner's portfolio that was, tilted towards Europe in terms of its holdings. But of course, like every one of these blue dots is one of the physical assets that's owned by the companies in that portfolio. And so you can then see that we've marked a couple of these events that have happened within the recent past. So you can have a Category 4 hurricane in Tampa, or you can have a major wildfire in Brazil. And you can see that there are these range of extreme weather events that can impact a portfolio of global companies. And in fact, what we found is that when you aggregate across these portfolios, 55% of the companies already face severe physical hazards. Today, that's about a quarter of the equity value of these portfolios. But some of these portfolios had only about 14% of their portfolio value be impacted, while others are as large as 60%, right? So these are the kinds of findings. So this is a chart that shows by different hazards, acute and chronic, what the range of exposures and impacts, estimated impacts are on these asset owners' portfolios. Now, this type of analysis raises questions for investors about aggregation, about correlation, about concentration risks on a range of physical hazards that standard portfolio tools in finance were really never designed to answer. So this is very much a new area, something for investors to be thinking about, is that where the risks actually might manifest is not country, sector, asset class. All right, so let me do a little quick time check here. All right, I'm still starting to come to the end here. Okay, so the final piece of the data story I want to share is, you can't get through a talk without AI. So how AI is changing what's possible. So, our teams have always had to make sense of an incredible volume and structured data. And of course, I don't think I need to tell you that AI has made it now possible to extract and structure and classify this information at a scale that was impossible even just a year ago. But what I think is more exciting is that AI is also helping us address the next frontier of questions that investors now have, which is about the investment implications of climate adaptation and resilience. And specifically, what are companies doing now to invest in their own operational resilience? And what are they actually doing to develop products and solutions that households around the world, businesses and governments are going to need in the coming years in order to adapt to a hotter and more dangerous climate? So we recently explored this question by applying new approaches and working with LLMs to explore some of these questions that is of high relevance to investors right now. I'm not going to go over the results, but I do invite you to take a look at the research. Now, the high-level finding is that we're able to surface and classify just a very wide range of corporate activities today that are already addressing different aspects of adaptation and resilience, and all of that comes from unstructured information. And I think it's a very exciting window into what might be some of the capabilities that AI may have in surfacing unstructured data for investment purposes. It does also raise quite interesting questions about the future of corporate reporting in the age of AI. And what is the value of actually standardizing measures? And what is the role of transparency? Right? We've talked a lot about that at the beginning of this talk, all of which, transparency has really been very much at the heart of the theory of change for sustainable investing movement. And if AI can really give you much more transparency than previously possible, what is the role of transparency and what is the role of corporate reporting? So I find all of this exploratory research to also understanding adaptation resilience as a topic to be really important, not really just for investors that are seeking investment outcomes, which has been the focus of everything that we do, but putting on a different hat, as part of the next cycle of the IPCC report, there's going to be, for the first time, a finance chapter on adaptation and not just on mitigation. And as one of the authors of the chapter, our preliminary assessment of the literature, we show there's a gap in knowledge about the nature and the scope of private sector activities to address climate adaptation and resilience. So what households, what farmers, what businesses are doing either proactively or reactively to protect themselves have societal-wide impacts and implications on just how wide this adaptation gap is going to be. There is very thin literature, I think, in this area, so I want to use this opportunity as a call to action for researchers in this audience. This is really an area of inquiry that I think is going to become increasingly important. So I'm going to close because we're starting to run out of time, and I do want to give you an opportunity to ask questions. Let me just summarize some of my main points. So following the money, I think, reveals both what the financial system is capable of, but also where it falls short. So this past decade, I think, we've really seen remarkable innovation. We've seen remarkable innovation in measurement, in the data infrastructure, and in how capital is allocated. I think that global investors, from what we can see, is not retreating from climate, and particularly in areas where the investment rationale is economic rather than policy. So the money is moving, and I've shown that to you in different ways. It is moving in ways that are actually, I think, more nuanced and sophisticated, I think, than most people outside of finance realize. But there are real limits. We know that finance, it can follow the real economy, it can price risk, but it can't actually substitute for policy. And then finally, we've talked a lot about data, so investors can demand better data. They can't really will all that data into existence without the underlying science that can feed into innovations and measurement. And so the quality of the investment decisions are really only going to be as good as the data and the models available. So let me end by pointing out that many of the hardest questions that we have on the horizon sit at the intersection of finance, climate science, operations, and public policy. So at the MSCI Institute, part of our role is to actually try to lower the barriers for researchers to engage with these questions. We provide free access to investor-grade climate and geospatial data. We've done collaborations with emerging scholars. I hope I've been able to interest some of you in how much practitioners are already making some important decisions that intersect climate science. And so now we really need more evidence base to catch up to better inform those decisions. So thank you very much. I think that it's important to know that investors can price risk, but at the end of the day, as a society, we're the ones who are going to have to decide what risks we actually want to reduce. Thank you.
Yeah, thank you so much. I'm curious to hear a little more about what goes into the alignment calculations, given that in a net zero national pathway or economy-wide pathway, not every individual actor and region hits net zero. So what goes into figuring out the allocation of someone's alignment at the firm level?
You mean from this the temperature?
Yeah.
So the budget is calculated for 1.5 degrees. You can do it also for 2 degrees if you wanted to. But it is actually based on an absolute budget, and we just allocate it based on what the NDCs and what each of the countries, as well as different sectors, might have under that overall budget. So for companies, they each get their individual one based on what it is that they actually do. And then what is more important is actually what their projected emissions trajectory is, because you can always change what's actually underlying in terms of the budget, but what's actually very important is whether or not their emissions trajectory continue at the same rate as it is now, or whether the commitments that they have made to decarbonize and to slow down their emissions growth will actually take place, because then you have a different kind of trajectory and a different budget that you might have left. The methodology is available. You can take a look at that.
Maybe I'll just have to ask one question myself, which is, you've spoken a lot about how companies are adapting to climate change and how investors may take those adaptations into account, and how many companies are not doing that much yet. I'm wondering, how are investors addressing or investing in mitigation strategies like renewable energy companies or critical mineral companies or electric vehicle companies? And are you seeing any big changes there in terms of increasing interest as it's more apparent that those changes will have to happen if we're going to avoid a really major increase in temperature?
So I need to just clarify that today investors don't know whether companies are adapting, right, to physical impacts. This is why some of this research is quite exploratory. I think what they have been responding to is whether companies have transition strategies. And that has been going on for several years, where I think investors actually do scrutinize companies' decarbonization plans, and that continues to happen. Now, when it comes to actually investing in opportunities, I think that that's where the picture has become more complex, because it really depends very much on the company's locations, what kind of markets they're in, and to what extent their technology adoption will be favored or not from a policy perspective. And that's why I think today investors are very interested in it, and they continue to look into it, but it's not nearly the same kind of across the board. Certain sectors and certain types of technologies are going to attract a lot of capital.
Yeah, thanks a lot for the talk. So you presented the climate value at risk metric, which I thought was a really interesting way to quantify a lot of the stuff that you talked about. How sensitive would you say that is to the timeline of a portfolio or a certain investment? Just, I know you mentioned long term, but depending on who you work with, the value might be a lot more, sensitive 30 years in the future than 5 years. So can you speak a little bit more to how sensitive it is to time?
Yeah, I think the first iterations of these is it really almost, it takes like an instantaneous shock, right? As if like all future climate impacts will happen and then they will get repriced immediately, which is obviously we know is not really realistic, but it gives you some sense of the different relationship. I think in terms of where the time horizon picture now comes in is the scenarios themselves. So I think that, I talked about the NGFS, that they are producing the standardized scenarios, and they've been under quite a lot of pressure to bring shorter term scenarios, because financial institutions, even very long-term investors, have to actually be able to see what these impacts look like in a time frame that they can do something with, not something that's 30 years in the horizon. So it's a very good question, and it's one that the industry really grapples with.
Thank you very much for a talk, very impressive. I want to touch upon a particular niche area, which is carbon market. So some companies do like to invest in some high quality carbon credits to offset their emissions to reach their net zero target. And I wonder, have you noted any shift like in those kind of investing strategies when companies decide to buy high quality carbon credits?
Okay, so we have a carbon markets data portion to what we do, and so we do collect all of the different prices and do project forward prices and so forth, even though we're not a developer. I think that the market has been relatively flat, I would say, over the last couple of years. I think there's been skepticism about it, and there's been kind of integrity issues, but I do think that the industry is making a lot of headways in terms of trying to resolve some of those types of issues. We have seen prices being fairly stable, I think, in terms of the kind of companies that are buying or buying more credits. A lot of them actually are energy companies. In the transition finance tracker that I was telling you about that we publish regularly has a portion on carbon markets, and we do list the biggest buyers and retirers of credits on a monthly basis. There's not been huge swings, I would say, in the last, let's say, year or two. And I think that market is just waiting to see whether there's some tailwinds that can actually kick it off. I think that in Asia they see much more interest, partly because there's some innovations where you can connect regulated carbon markets with voluntary carbon markets.
Yeah.
Great. I think we have time for just one more question.
Thanks. This is very informative. I've worked both in Canada and in Texas, so you get kind of two sides of the view addressing these issues. This is kind of ancillary. Engagement and banking lending. There are two areas where you can have a third party have influence on corporate action. So I'm wondering, how is that going? Is engagement still very strong? Because you have to own it to influence a company versus divestment. So, that's the model I came from. But then also, bank involvement in financing. How has that changed? Has that shifted? Has it been more assertive in guiding?
So I think in terms of engagement and stewardship, that's still very much at the heart of the theory of change of the largest asset owners in the world, right? So I think they continue to be very active in terms of engaging companies, especially those that they think should have a more credible transition plan, and that if they've made commitments that are not sufficiently ambitious or are ambitious but have no real plan or they're off track, I think that they definitely continue to be engaged by the stewardship teams of many of these investors. I think when it comes to banks, I do think that there's probably been some shifts because of the net zero alliances. I think that there was a period when many banks did feel under pressure to try to deliver on some of their net zero commitments, but I think that, as I kind of went through, there are just a lot of complications or a lot of barriers to the extent to which you can do that. So I do feel like at the moment, banks are probably much more focused on trying to provide financing for example, renewable energy. I mean, there's just a lot of sort of financing opportunities in that direction. It's just that, in the kind of climate that we're in at the moment, I think banks as well as other financial institutions are not out there kind of shouting from the rooftops about what they're doing.
Well, thank you so much.